to remind us, yes, to remind us where did we learn, where did we stop, what did we learn yesterday, and we're gonna pick it from there. Yes, we are about to come to the end of our class, talking about different types of candlestick chart patterns, the most likely chart patterns. Yeah, the most likely chart patterns. And then we will have some time to go to TradingView, and then we look at some of the chart patterns that we may find, and then see what was the interpretation after those chart patterns appeared. Yeah, but we are almost there. We are about to finish our chart patterns. I think today we are finishing them, and then we will look at some of the chart patterns in our TradingView. Yes, I think we will do that tomorrow, so that we end the week nicely, and then I'll be handing over to Coach Julius to take us from there. Yes. So can I check my voice? If you are able to hear me, give me a 1 in the chat. If you can hear me, give me a 1 in the chat. If you can hear me, give me a 1 in the chat. Am I audible? Am I audible? Am I audible? Am I audible? The signals are flowing. The signals are flowing. Yes, the signals are flowing. Don't forget that signals are flowing. Yes, subscribe to your different WhatsApp groups. Yes, to the Telegram channel. Signals are flowing. Okay, all right. So yesterday we looked at two chart patterns. We looked at two candlestick chart patterns. Yes. Can you tell me the two chart patterns that we looked at yesterday? Can you give me the names of the two chart patterns we looked at them yesterday? What did we look at? 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 The chart patterns, we looked at them yesterday. Chart patterns, we looked at them yesterday. Copy and paste. Copy and paste. Copy and paste. Make sure you don't copy the wrong answer. If you are copying and pasting, make sure you don't copy the wrong answer. Yes. Copy and paste. All right. Okay. Thank you so much. We looked at the Harami chart pattern. Okay. We looked at the Harami chart pattern, and we looked at the tweezers. Yes. We looked at Harami. We looked at both of them. We also looked at the tweezers. So when it comes to tweezers, we also looked at both of them. We looked at both of them. All right. Now, when it comes to tweezers, we learned about the tweezer top and the tweezer bottom, right? The tweezer top and the tweezer bottom. Between the tweezer top and the tweezer bottom, which one is a market reversal signal to the upper side? Between the tweezer top and the tweezer bottom, which one signifies market reversal to the upper side? Give me an answer in the chat. Between a tweezer top and a tweezer bottom, which one signifies market reversal signal to the upper side? Which one? Which one? Between the tweezer top and the tweezer bottom, which one tweezes the market to the top? Which one tweezes the market to the top? Between the tweezer top and the tweezer bottom, which one tweezes the market to the top? Which one? Which one? Which one? Which one tweezes the market to the top? Seems like some they are not sure. they are waiting for others to give answers. And when they see that one answer has been twisted a lot, then they will copy and paste. Yes, they will copy and paste. All right, so it is a tweezer bottom, which is a market reversal signal to the upper side. Yes, it is a market reversal signal to the upper side. All right. So we have covered so far different types of chart patterns. Okay, different types of chart patterns that we have been looking at. As we come to the end, I just want us to have a recap. Yes, I just want us to have a recap on the different types of chart patterns we have been looking at so far. Yes, it's only, I think today we're gonna do one, then we're gonna do a summary. All right. So I want to check those that have been attending from the day we started looking at our chart patterns. Yes, from the day we started looking at our chart patterns. I want to see those that have been here. Yes. Can you tell me some of the chart patterns that you can remember? Some of the chart patterns that you remember that we have covered in our training. Some of the chart patterns you remember that we have covered in our training. Yes. Some of the chart patterns that you remember that we have covered in our training. Can you give me some of the chart patterns that you remember? 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 The shooting star, the pin bar, the doji, the gravestone doji, the dragonfly doji, still one family, the hammer, the bearish engulfing bar. What else did we learn? What else did we learn? What else did we learn? The bearish engulfing bar, the morning star, engulfing bar, dojis, tweezers, harami. Okay, okay, all right. Pin bar, engulfing bars. Okay, evening star. Yes, evening star. All right. What else? What else comes to your mind? What else comes to your mind? What else comes to your mind? We are just doing a recap. Then after that, we're gonna end with one. Then we're gonna call it a day. And then tomorrow we are going to look at we are going to look at them in our trading view. We'll be trying to locate them. Yes, we'll be trying to locate them. Yes, so I wanted to see if you are able to remember what we have covered so far, okay? So our journey started from engulfing bars, right? That's where we started our journey. When we started opening at candlestick chart patterns, we looked at engulfing bars. So on the engulfing bars, we looked at two types of engulfing bars, all right? Yes, the bullish engulfing bar as well as the bearish engulfing bar, if you remember very well. Those are the two types of engulfing bars that we looked at. Yes, the engulfing bar and the bearish and the bullish. Okay. Yes, we were talking about a candlestick chart pattern that is having two body candlesticks. From there, then we looked at from the engulfing bars, then we looked at a family of dojis, right? We looked at a family of dojis. I'm just doing a recap. Probably someone is saying, why are you not sharing your screen? I'm not sharing my screen. All right, I'm doing a recap. So if you are having your notes, you are able to refer, you are able to understand what I'm talking about. So we looked at a family of dojis. All right, we did define what is a doji. Okay, yes, how does it come into space? All right, then we looked at their types, the doji family. Then we looked at the dragonfly. Yes, we looked at the dragonfly, which is a market reversal signal to the upper side. And then we looked at, after the dragonfly, we looked at the gravestone doji. Those are the two types of dojis that we looked at, gravestone and dragonfly. One is for the upper side and the other one is for the downside. Okay, yes. And there we did not end there. We looked at another type of a chart pattern called a morning star. Okay, yes, the morning star. We looked at a candlestick chart pattern that consists of three bodies or three candles. The morning star. The morning star, it is a market reversal signal to the upper side. That's what we said about the morning star. Okay, so when stars have stopped appearing in the morning, then we looked at stars that appears at evening, which is the opposite version of the morning star. We looked at the evening star chart pattern. All right, we looked at the evening star chart pattern. Okay, yes, so we said that the evening star, it is the opposite version of the morning star, which signifies market reversal signal to the downside. That is about the evening star. Okay. Then we spoke about the hammer. We spoke about the hammer, which is called a pin bar. We spoke about the hammer, which is called a pin bar. We also discovered that uh, when we are looking at a hammer, we are looking at a market reversal signal to which side? To the upper side. Okay. Yes. When we spoke about a hammer, we were looking at a market reversal signal to the upper side. That was the hammer. All right. Then we looked at the opposite version of a hammer. All right, the opposite version of a hammer, which is a bearish pin bar. It is called a shooting star. Okay, a shooting star, it is a bearish version of the hammer. Okay, yes, that is the shooting star. A market reversal signal to the downside. A market reversal signal to the downside. Not only did we look at the bearish pin bar, we also looked at a Harami chart pattern, which was yesterday. We looked at a Harami pattern, which is also called as the inside bar. Okay, the Harami pattern, also called as the inside bar. All right, yes. So we looked at both of them, the one for bullish and the one for bearish. We looked at two of them. Okay, the bullish inside bar and the bearish inside bar, which is the Harami pattern. All right, then we ended up with the tweezers, where we were busy looking at tweezer bottoms and tweezer tops. All right, so we separated them into two, the tweezer top and the tweezer bottom. Those are the two tweezers that we were looking at, and we discovered that a tweezer bottom is the one that tweezes the market to the top, while a tweezer top is the one that tweezes the market to the bottom. In simple language, in simple understanding, that's what we looked at. Okay, so that was the recap. That was the recap. And then today we are going to look at this other chart pattern that we are going to conclude with. Yes, I'm going to share my screen, and then we finish from what we left yesterday. We are going to proceed from where we left yesterday. Okay, I'm going to share my screen. Then we are going to look at this other candlestick chart pattern. All right, is my screen visible? Can you see my screen? Is my screen visible? 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 If you can see my screen, give me a 1 in the chat. If you can see my screen, give me a 1 in the chat. If you can see my screen, give me a 1 in the chat. If you are able to see my screen, yes, give me a 1 in the chat. Okay. All right. So let's get into this other chart pattern, another candlestick chart pattern, another language that is spoken in the market. All right. Yes. So we do have 2 of them. I have brought them, all of them at once here, but we're going to look at one at a time. Okay. So let us look at a chart pattern called the 3 white soldiers. Yes. The 3 white soldiers, that's what we are going to look at, and then we are going to conclude here. All right. So there is a chart pattern called the 3 white soldiers. The 3 white soldiers. All right. The 3 white soldiers. So we are going to look at them and get understanding about these 3 white soldiers, as well as the opposite version of the 3 white soldiers, which is the 3 black crows. The 3 black crows. All right. So let's get into it. The 3 white soldiers. These are the 3 white soldiers which are on the left screen. Okay. These are the 3 white soldiers. All right. So the way it is displayed, the market is trending this way. As you can see, the market is trending from the upside going to the downside. Okay. So we have been speaking about levels of resistance and levels of support. Okay. This is going to be done properly with our coach when he comes in. We're going to learn about support and resistance. We're going to learn how to draw these levels of support and resistance, right? Yes, but I'm just using them in passing so that you understand what do I mean when I say support and resistance levels. So the market is trending from the top going downward. Okay, so it reaches this area where in most cases when it touches, it reacts to it or it bounces back. So the market has been trending that way down, then it reaches the oversold area or the resting area for sellers. Okay, so when the market reaches this area, if you do not see those other market reversal signals, that signifies bullish momentum, meaning to say a reversal to the upper side. You are going to see this type of a candlestick chart pattern called the 3 white soldiers. Okay, the 3 white soldiers. The 3 white soldiers consist of 3 candlesticks. It consists of 3 candlesticks. Don't forget this. The 3 white soldiers consist of 3 candlesticks. Okay, so the 3 white soldiers, it is a bullish candlestick chart pattern. The 3 white soldiers, it is a bullish candlestick chart pattern. It is used as, yes, it is used to predict the reversal of the current trend, which is a downtrend. Okay, the 3 white soldiers, it is a bullish candlestick chart pattern. It is used to predict the reversal of the current trend. In this case, we are looking at a downtrend. This is the current trend, right? So it is predicting to us that the market is going to reverse to the upper side. So in this case, this is a bullish candlestick chart pattern. All right. Now let's identify them. I said it consists of three candles. It consists of 3 bodies. Okay. Now, these bodies or these candles, we call them consecutive long-bodied candles. They are consecutive long-bodied candles simply because each candle, when you look at this candle, where it closed, you can see that the next candle is starting from there. Let me repeat. When we say 3 consecutive candles, okay, 3 consecutive real body candles, I'm simply saying, when you look at this nature of a candle, when this one closes, the other candle opens on top of it or just above the closing price of that candle. Okay, as you can see, the other one also is starting slightly above the closing of the previous candle. What does this mean? When a candle opens above the previous opening price, it tells you that the power that closed in this session, it is still in control, or it did not give room for the other power to come in and do some activity. So in most cases, you will find out that these types of candles, their shadows, they are small, or there is no shadows at all. I don't know if I'm trying to put something across here so that you are able to understand. Can you see this candle when it closed? Okay, when it closed, can you see the size of the shadows that has developed on this candle? It's very small candles. Okay, I mean it's very small shadows. This tells you that this power that was in control here, it maintained it. It did not allow the other power to show their presence. Okay, this power which was in control here did not give enough room for the other power to demonstrate that we are many here. So they tried to close them up. In this case, I'm simply saying sellers, they were not enabled to appear here. It is buyers that are taking charge here. When this candle was closing, buyers, they painted a good picture, or they demonstrated that we are many than you sellers. So when the next session is opening, it is opening slightly above the closing price of the other candle. So the pressure in this candle, you can see that it is full. Yes, it is full. There is a lot of pressure here. The same applies to this other candle. There is also pressure. So where it closed here, it opened there. They maintained their position. Immediately when this candle opened, it tells you that these guys, they maintained their positions. They did not allow the selling activity to take place. Okay, so this is what is happening. Immediately when this one closes, above it opens another one, not allowing a chance for sellers to do the activity of selling. That's why you see there is a small shadow there. So buyers, they are still maintaining their pace to make sure that they are pushing this market further. So in the long run, you see three consecutive candles, that are opening above the previous one when it comes to opening price. This one opened at totally above of this other candle. This one opened above at this candle. So you can see that there is no chance for sellers to show off that we are here actually in many numbers. We are here in numbers. They are not showing. They are not giving a room for sellers. So the pressure here signifies that buyers, they are in control. That's why it is called the 3 white soldiers. These guys, when they stand up, when they show that they are really soldiers, you should expect a long uptrend. When the three white soldiers appears, you should expect a long uptrend. But you also needed to confirm, like I said with the other chart patterns, before you make your entry, you needed to use other confirmations to make sure that your entry is valid. Okay, you have to use other confirmations to make sure that your entry is valid. Yes, because sometimes it can be a fake. It can be a fake. So make sure that you don't only use the candlestick alone to interpret your entry, but you should also confirm with other tools to confirm your entry. So this is what we call the three white soldier candlestick chart pattern, which is a market reversal signal to the upper side. All right. So you can see that we don't have long shadows here. We don't have long shadows on the candles. Because of this, it signifies that the buying pressure is more than the selling pressure. Because when you see a candle with a long upper shadow, okay? When you see a candle with a long upper shadow, it tells you that there is selling pressure, or there was selling pressure in that candlestick. But when you look at this, you see that buyers, they are finishing their trade session, maintaining it. They are not allowing a lot of selling to happen. Okay? They are not allowing a lot of selling to what? To happen. So it's like they have built a strong defense. They don't allow the opponent to come and score. If we were to talk about soccer, we could use that language. That buyers here, they have put a strong defense at the back. They are not allowing sellers to come and score. After they have taken over from here, when they took over from here, when the market started to rise, going up, they are not giving any room for sellers to take over. That's why the appearance of small candles on the bodies, sometimes there is no wicks, okay? There is no wicks, there is no shadows on the bodies of the candlestick. That signifies buying pressure is in control. Buying pressure is in control. So this is the three white soldiers candlestick chart pattern, signifies bullish market, bullish momentum. We are doing what we call technical analysis, predicting the market that it might reverse to the upper side or it might reverse to the downside, looking at what is happening in the market, probably from history. Probably from history. Yes, this is history. We are looking at where the market is coming from. I don't know if I am speaking to somebody. If you are here with me on the three white soldiers, give me a 3 as well in the chat. Give me a 3 in the chat if you have understood about three white soldiers. If you have understood about three white soldiers, give me a 3 in the chat. Give me a 3 in the chat. Give me a 3 in the chat. Am I still here? Am I still here? Am I still here in the Zoom? Am I still here in the Zoom? Am I here in the Zoom? Okay, I thought I'm talking to myself. All right. Okay. So those are the three white soldiers. It is a candlestick chart pattern that signifies market reversal to the upper side. It is a prediction of the market to reverse to the upper side. All right. The three white soldiers. Okay. The three white soldiers. All right. So the next to it, The next to it, it is the opposite version of the three white soldiers. Okay? These ones, they are not called soldiers. They are called crows. Okay? These ones, they are not called soldiers. No, they are called crows. Yes. Yes, they are black, but those ones, they are white. So these ones, they are black. Yes. So these are the three black crows. Let us look at them. Let us look at them, the three black crows. But you just need to understand that the three black crows, it is the opposite version of the three white soldiers. So the formation is still the same. The formation is still the same when you look at the nature of the body of the candlestick. They are three as well. We are having this candle, and this candle. Can you look? Can you see the presence of dodges? I mean, of shadows there? The shadows that are developing on this candle, they are very small. That tells you that buying activity, it is so little. Buying activity, it is so little. Can you see how they open the market? Yes, it is flat, 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 flat. This signifies pressure. When you see a candle that is flat, when the price is being opened, it signifies pressure in that candlestick. So you can see that the shadows, they are so small. So sellers, they are not giving a room to buyers to come and buy. Sellers, they are not giving a room to buyers to come and what? And buy. Okay? So what are they doing? They are putting pressure on the price to go down. They are pressing the price downward. So the formation of the candles, okay, can you see is full-bodied candles? They are full-bodied candles. This signifies that there is a lot of selling pressure going downwards. Buyers, they don't have a chance at all. These guys, the black crows, they are still crawling. Yes, they are still crawling the market to the downside. So they are very serious when they are pressing the price downward. The formation of the candles tells you that here, it's going to be a long downtrend here. When you see a market like this, when you see a market like this, you need to understand that it's going to be a long downtrend. So if you were on top here, if you were on top here and your capital is finished to open margin calls, then you need to make sure that you've got some tablets for patience. Yes, you have taken some tablets for patience because you are going to hang here. Yes, the market is going to find you there. I don't know when. But you need to stay here because the market will trend downward because of these guys, the three black crows. They are pushing the market to the downside. So the formation is the same. What happened here is also what is going to happen here when it comes to the body of the candlestick. I don't know if this is simplified. I don't know if this is simplified. If you have understood the three white soldiers, then you also need to understand the three black crows because it is a bearish version of it. So this is the bearish version of the bullish version. When the market is being pushed by these guys, when these guys appears, they push the price downward. But I am saying the presence of the three white soldiers when they appear and the presence of the three black soldiers when they appear, it means that that trend, it is going to be a long one. They normally appear after the market has been trending for some time. Yes, after the market has been trending for some time, whether it was trending upward, when these guys appear, you should know that it is going to be a long downtrend. So when you find the three black, the three black crows and the three white soldiers, you should understand the definition of the market. What is most likely to happen in the market? What is most likely to happen in the market? So those are the three black crows, which are a bearish version of the three white soldiers. Am I speaking to somebody here? If you have understood the three black crows, give me a 2 in the chat. Is it my network? Somebody says my network. Are you talking about me? Is my network okay? Is my network okay? Did I break somewhere that you did not hear me? Is my network okay? Okay, all right. I thought my network is not okay. Probably you did not hear me. Okay, all right. Okay. Okay, all right. So those are the three black crows and the three white soldiers. That is the family of the three white soldiers and the three black crows. One of them signifies bullish, one of them signifies bearish. Market going to the top, market coming down. All right. Yes. Now, I want to conclude with this today. I want to conclude with this. Allow me to load in my TradingView application here. Let me bring in my TradingView application. I want to close here. All right. I want to close my session here on TradingView. After looking at the three white soldiers and the three black crows. Okay. So I just want to conclude my training here. I want to conclude my training here on TradingView application. Okay. I just need to use the board here to write because there is something that I want us to look at. Okay, let me remove the indicators here. I want to conclude here. Okay. All right. So I want us to understand one thing. I want us to understand one thing. When the market is trending to the top or when the market is trending downwards, okay? When we are analyzing this candlestick chart pattern, whether the market is trending to the top or the market is trending downward, it makes some moves. So I want you to understand those two moves. All right, what the market makes when it is trending upward, when you see that the other family that pushes the market to the top is present and the market has started to trend upward, or either the market has started to trend downward, what does it do? The market, how does it go up or how does it go down? Because we needed to understand that when the market is rising, yes, unless it is pumping, but it makes moves when it is going up. It makes some moves when it is going upward. All right, it makes some moves when it is going upward. So if you are to draw your line here, okay, you draw your line here, okay, you draw your line there, you draw your line there. Yes, my lines are not perfect, but there's something that I want to present to you. When the market is trending upward first, then I'm gonna come to when the market is trending downward. Okay, I want you to look at this movement that the market makes when it is going up. Okay, when it is going up. Am I still with you here? Am I still with you here? If I am with you, give me a 3 in the chat. If I am with you, give me a 3 in the chat. If I am with you, give me a 3 in the chat. I want to demonstrate something. Then I think it will be the end of my sharing for today. It will be the end of my sharing for today. Okay. So here we are. When the market is trending upward, it makes a move. Okay. We are coming from the bottom here, where there is a market reversal signal has appeared, that the market is making an upward movement. And now the market will start to trend going upward. When it is going upward, it makes some moves. It goes up, then it corrects. It goes up, it corrects. It goes up, it corrects. It goes up, it corrects. All right. So when you come and understand how to draw your line of support and your line of resistance, you are going to be able to catch these moves that are being created by the market. So the first move when the market is going up, okay, this move of going up before it comes down, it is called an impassive move. It is called an impassive move. Okay, this is an impassive move that the market is making. When the market is trending upward, it makes two moves. It makes two moves. So the going up of the market before it retraces, it is called impassive. So if you are to enter the market, you should follow the impassive move. Okay? When it is making a correction, you get out of the market. What am I trying to say? When you have drawn your line of support and your line of resistance, when you enter, for example, from point A, where the impassive move is starting, then the market comes and touches this wall called the resistant wall. You are going to exit here. Then you wait. You wait for the market to retrace. Is it going to continue to go up, or probably it will come down again here? Okay. So you enter here, you exit here, you wait for the market to come down or to retrace. When it has done the retracement, it's when you will be preparing to enter again to climb with another impassive move that the market is going to make. So these moves of going up, going up, going up, they are called impassive moves. What about these moves that are coming down? They are called retracement. That's why if you are able to remember, I said that there is a difference between retracement and reversal when we are talking about market reversal signals. Yes, I said there is a difference between retracement and reversal. So when the market is going upward, it makes two moves. The first move that it makes, it is an impassive move. So if you have learned about this technical analysis very well, you are going to find yourself that you're going to enter when the market is making an impassive move. Before it retraces, you exit. In this case, you have already drawn your lines of support and your lines of resistance. So immediately when you enter at support, you exit at the next resistance. You allow the market to retrace. When it makes another impassive move, you enter. Your target of exit is the next resistance level. So this is the market making a move to the upper side, making these moves called impassive. These moves that are coming down, correction, okay? The correction moves, they are called retracement. I don't know if I'm trying to paint a good picture when it comes to the market going up and the market going down. But I wanted you to have a look when the market is going up. What moves does it make? it makes impassive, it retraces. It makes impassive, it retraces. It makes impassive, it retraces. These are the pullbacks. That's why when you look at our Royal Q robot, it is built along these lines. Have you ever seen whenever it want to sell after it have reached a take profit? Yes, there is what we call a take profit callback. There is what we call a take profit callback. So Royal Q is built along this system on how the market moves. The same applies when it is buying. There is what we call a buy-in callback. So before I go to the downside of the market, have you understood these moves that the market makes when it is going up? Have you understood these moves that the market makes when it is going up? These two moves, the impassive and the retracement moves. Give me a yes if you have understood the two moves. Give me a yes if you have understood these two moves. Give me a yes if you have understood these two moves. If you have understood these two moves, give me a yes. Before we go to the other side when the market is coming down, what moves does it make? How do you follow it? How do you enter? How do you exit when the market is trending downward? Okay. All right. So it seems we are on one page. We are on one page. Let me go back to the app again so that I can use this whiteboard appearing here. Okay. So this is a retracement and impassive moves that the market makes. Now let's reverse. Let's come from the top and then go downward. Let's come from the top and then go downward. Okay. Let's come from the top and then go downward. Right? Yes. Let's make our moves this way. Let's make our moves this way. Right? Just for learning purposes. I may not draw them perfectly, but just for learning purposes. All right. So we draw our line here. Okay. We draw our line here. Okay. Wherever the market makes a correction, we put a line. Wherever the market makes a correction, we put our line. It can be a support line. It can be a resistant line, depending on where the market is going or where the market is coming from. So now, this is the market going downward. Okay. When the market is going up, it makes impassive. It makes impassive, right? When it is going up, it makes impassive. But now, this impassive changes when the market is going down. Okay? When you are trading a trending market, uptrend market, you follow the impassive. When the market is going to the top, you enter with impassive. That's how you enter it. Okay? When the market is going to the top, you go with impassive move. But when the market is trending downward, you don't follow the impassive, you follow the retracement now. When the market makes this impassive, okay, when it has done the impassive move, you wait for the correction. Remember, this market is going downward. Okay, it is going downward. Sometimes this correction, it may touch this other wall here before it comes down. It may touch this other wall, it comes down. Okay. Sometimes it is ranging. It will be doing this type of moves. It will be doing this type of moves. It is ranging. going sideways. Okay. So how do you trade these type of markets? I'm saying understand first, what are these moves called? When you understand them, then you are able to find yourself where you can enter, where you can exit. So if the market is making impulsive moves and then retracement moves, when it is going downward, you enter with retracement, you don't enter with impulsive. This is impulsive, this is retracement. This is impulsive, this is retracement. This is impulsive, this is retracement. So initially you can enter here, exit 3/4. You wait for the market to come back, you enter here, you exit 3/4. You are taking profit. The market retraces, okay, which is an impulsive move. Then you enter, you exit. When it is this type of a market which is trending downward like this, it means you can enter here. When it makes a retracement, you enter, you exit. The market comes down again with another impulsive. You prepare for your entry. Then you exit at the end of the retracement. The market comes down. You prepare to enter. You exit with the end of the retracement. As the market is going down, you are still taking profit. That is after you have drawn your line of support, your line of resistance, your line of support, your line of resistance. These lines, they are going to direct you when should you enter, or where should you enter and where should you exit. Where should you enter? Where should you exit? I'm simply saying a downward market can also give you profits. A downward market can also give you profits when you know how to analyze the market. Am I making sense to you? Am I making sense to you? With our Royal Q robot, you can trade a market that is going down when you understand the moves that the market is making. So sometimes your take profit might be small, looking at the type of moves that the market is making when it is going down, because sometimes it may not be a full 3%. You might take 1.52%, 1.52%, 1.52%, because the market is on a downward trend. The pullbacks, they are not long enough for you to take 3%. Guys, am I preparing you for what is coming? Am I preparing you for what is coming? Am I preparing you for what is coming? When the market is trending upward. Yes, when you study these moves, you're gonna know when should you enter and when should you exit. You wait, you enter, you exit, you wait, you enter, you exit, you wait. So you follow the trend. The trend becomes your friend. That's why we normally say the market will never be your friend, but the trend of the market can be your friend if you know how to make friendship with it. If you know how to make friendship with the trend of the market. That's what we are trying to analyze here. Yes. But tomorrow we're gonna go to this trading view and then start looking at the chart patterns that we have been looking at. But I wanted to conclude with this part. When you have seen that chart pattern that signifies upward movement, how do you follow that trend to the top? When the market is going downward, if you are having capital, how do you follow that downward trend and collect small profit when the market is going down? How do you go about it? It is going to be more simplified when you have learned how to draw your support and your resistance. Then you're gonna know, or you're gonna create areas of entry and areas of exit. Did I speak anything about a launch pool? Did I speak anything about the launch pool? Someone is asking about a launch pool. I'm not talking about that. That is a different subject. I don't want to mix that with this. I never spoke about a launch pool here. Please don't confuse other learners. Yes, you're bringing another subject, so you want other learners to be confused. Now I must move from candlestick chart pattern, then I speak about launch pools. Come on, guys. Anyone with a question of what we have discussed today? Use a longer time frame, 4 hours. Yes, 4 hours, 1 day, 1 week. 4 hours, 1 day, 1 week. When you are analyzing the market in 4 hours, it means you want to come and trade the market in 30 minutes, in 15 minutes. Okay? That's what you are doing. So do the analysis in longer time frame. For these market reversal signals to be valid, analyze the market in longer time frame. Anyone with a question, guys? Anyone with a question on what we have discussed today? Anyone with a question on what we have discussed today? Anyone with a question on what we have discussed today? I'm trying to check if there are questions. So these are chart patterns, language of the market. Yes, I was giving an example of 1.5%, because when the market is trending downward, sometimes the pulls that it makes, okay, the pullbacks, I'm using the word pullbacks, okay, sometimes they may not be longer enough to be 3%. This is what I meant, okay? When I say you can collect 1.52% probably, when the market is making these moves, it will pull a little bit to this side, then it comes down again. It pulls a little bit that side, it comes again. It pulls a little bit that side, it comes again. So from this point to this point, if you measure, you discover that it is a small take profit, probably 1.5 or 2%. Okay, that's what I meant when I say you can collect 1.5 or 2%. It depends on how much is a pullback. Because remember, you have drawn your lines like this. 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 So when you measure from this point to this point where you are planning to exit, how much is it? How much take profit is it? Now the market comes down to this other line, breaking your previous support. This previous support is broken. The market has come to the second support. Now it is supported here. It goes up, it bounces back. The previous support becomes your resistance now. That's where the market is being resisted. When it is resisted there, it comes back again here. Probably it breaks the next support. It comes to the third support. So when it is making these moves, you calculate, you measure from this point to this point, this point, this point. You discover that they are small take profit, 1.5, 2%. Remember, this market is going downward. So you don't put huge take profit. Otherwise, the market is going to leave you here when it is continuing its journey of going down. It leaves you here without you exiting the market, without reaching your take profit. Have you ever seen that you were in in profit. You were in profit of 1.5%, right? When you check your RoyalQ application, the coin was in profit of 1.5%. You started jubilating. You started being excited because you have landed now in profit. The next hour or the next 2 hours, your 1.5% becomes negative. The market goes down against you. Then you said, I was supposed to sell more. I could have sold that 1.5% and take it. Yes, this is what I mean. When the market is going downward, don't be greedy. Collect the small profit and get out. Allow the market to go down again. When it is retracing to the top, then you enter, you make your entry there, you exit on the next resistant line. Then you allow the market to come down again. This is what I am simply saying about 1.5 or 2%. It depends. It depends. Am I making sense? Am I making sense, guys? When you are trending a downward market, am I making sense when it comes to your take profit? No, I did not talk about ranging markets. Yes, that's true. My focus was not on ranging market. I didn't speak much about ranging market because it was not my focus. Yes. No, when you are having margin calls, every drop is not a profit. When you are trading with margin calls, every drop is not a profit. When you are trading with margin calls, it simply means when you enter here, for example, let me just do some writing right away here. Where is my cursor? When you are trading with margin calls, okay, you are trading with margin calls, okay, your robot has entered here probably, which is point A. The market comes down to this level, okay, your margin call has been achieved. Then when the market goes up here, okay, then our robot buys, because our robot buys when the market pulls up before it comes down. First, it needs to come down with our drop. It should come down with our drop. When it rises a little bit up is when it buys. Okay, so when it buys here and the market comes down here, which is the first margin call drop, okay, then our robot buys here again. It means it is going to bring this price here. This price here, it will pull it to this stage. So the market is not leaving you here on top. No. When the market goes down, you follow it because your robot is still buying. Your current price is being chased by your average price. When the robot buys here, it creates average price. It will come down here. When it buy your margin call here, it is going to create another average price here, meaning to say it is going to pull this one to come down to this one. Then the market goes down again. When it goes up, your robot buys another margin call. It is going to create another average price here. So when the price goes down, this average price goes down with you. That's what I'm trying to say. When you are trading with margin calls. So when the market reaches here, for example, before it starts going up, you are not here where you bought first time. Probably you are here. You are on this level. So when the market starts to rise, you are not going to go here, up here, for your robot to sell. No, you are hanging here. You are hanging here. So any movement from here to go up, you are out of the market because you have been buying when the market was going down. Your average price is following the current price. So anytime the market will start to reverse, you don't stay longer in the market. But if you were not buying, when the market started to move from here, the market needed to come up here where you were here at this level. Do you understand? So when you are buying downward, you are making yourself to get out of the market quicker when the market starts to rise. That is about margin calls when you are trading with margin calls. Yes. A sudden huge drop in the market, probably there is something that has happened that we cannot control. Yes, the market can drop in a sudden, a huge drop, of course. Just like when Bitcoin can drop from 60,000 to 55,000, you are going to discover that the auto coins, hey, they are showing you flames. All right. So those types of drops you don't control. Probably there is something that is happening in the market about those huge drops. Yes. Am I making sense, guys? Did I answer these questions that are being asked here? When you are following the downtrend, when you are trading following the downtrend market, okay, when the market makes an impassive move, you follow the retracement, you don't follow impassive. When you are trading a downtrend market, you follow the retracement, you don't follow the impassive. But when the market is trending upward, you follow the impassive, you don't follow the retracement. Because in the upward market, the retracement is the falling. In the upward market, this is the retracement. Impassive retracement. Impassive retracement. Impassive retracement. So when the market is doing this, you follow impassive. You enter here, you exit there. You allow the market to fall, which is a retracement. When it falls, you prepare. You enter here, you exit on the next. Okay, that is market upward. Market downward, you don't follow impassive, you follow retracement. It comes this way. This is the impassive, it retraces. Impassive, it retraces. Impassive, it retraces. Just like that. So you allow with retracement. You enter retracement. When it is going back to the ceiling here, you exit. It comes down, which is impassive. You enter here. When it is going back to the ceiling, you exit. You have already drawn your lines. These are 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 your lines. So you measure from this to this, this to this. Those are going to be your margin calls, including take profit. Now I am teaching you how to trade. That was not my intention. My intention was for you to know the moves that the market makes, because Coach Julius will come and teach us about support and resistance so that you find your positions of entry and your positions of exit. Is that clear, guys? Is that clear? Anyone with an issue? Am I owing anybody here that I did not answer the question? Yeah, you can go and watch the recording. We do have a recording on our YouTube channel. If you want a recap on the chat patterns that we were explaining, I cannot go back there and do a recap. We do have a recording. Okay. Daniel, go to our Crypto Ambassadors YouTube channel. All these lessons, they are recorded. So you can go there and look at the lesson that you missed. Don't worry about how do you measure your take profit. You're gonna learn. The lesson is coming. How do you measure your take profit? Yes, after drawing those lines, you're gonna learn tools. How do you use to measure take profit? How do you put your margin call drops? But I wanted you to know that how do you take advantage of a market that is going down, of a market that is going up? How do you enter? How do you exit? How do you enter? How do you exit? How do you follow the trend so that it becomes your friend? Is that clear? JK, your answer is going to be answered when you keep attending. You are going to know exactly where do you enter, where do you exit. If you are to reduce your take profit so that you come out, it means when you are entering the trade now, when you are entering the trade now, yes, you may come out, you may come out of the trade when you reduce your take profit now, when the market started to rise. When the market started to rise, then you're gonna get out faster because you have reduced your take profit. But I'm not saying when you change your take profit now, you will come out. No, I'm saying you're not gonna take long when the market started to rise, the market of that coin that you are floating with. When it started to go up, since you have reduced your take profit, you want stay longer there. Yes, you want stay longer there. But you're not gonna get out immediately when you changes your take profit. No, because you entered probably at a higher price, or the market went down against you. So you are still hanging up there, and the market is down far from you, from your entry. So it needed to come back to you. It need to come back to you. So when it started coming back, if you reduce your take profit, you will discover that the moment it is 1.5, you are out. Someone is 3% take profit. It means they have to wait. Okay, they have to wait for 3%. You are only taking 1.5. The moment it gets to 1.5, your robot sells. Someone with 3% is still in the market. That's the difference. All right. So guys, let's end here. Thank you for attending. Tomorrow, don't miss. Tomorrow, don't miss. We are going to look at those chart patterns in our trading view. We're going to go and find them and see them. How do they look like when they have happened? What the market looks like after they have happened. So we're going to be doing that tomorrow. We're going to be doing that tomorrow. So thank you so much, guys. Allow me to end the session here, preparing for another session that is coming at 9 a.m. 9 a.m. Yes, East African Standard Time. No, not 9, 10 a.m. Yes, East African Standard Time is 10 a.m. But South African time, it is 9 a.m. Just 1 hour from, is it 1 hour from now? Yes, 1 hour from now. Okay. So thank you so much, guys. You have been awesome, and thank you for attending. We love you, guys. Be patient. The market is not doing well. The market is not doing well, but be patient. We are looking at what is coming ahead of us. Okay? We are looking at what is coming ahead of us. It is so huge. It is so big. So be patient with the market. All right? Yes. Understand that there is something happening in the market. So just be patient. Just be patient. All right. So see